There seems to be a growing debate. Is the real estate market overheated? Are housing prices going to crash in 2021? Well, the 2021 housing market picked up right where it left off in 2020. That is, it's a market with prices still rising quickly, diminishing supply, and demand as high or higher than we were at the same time period last year. Yet we hear growing concerns about a looming market crash, so I'm going to address this today. My name is Ryan Ward. I'm the broker and owner of Premier Atlanta Real Estate, and on this channel, I talk about the Atlanta and national real estate markets with a focus on helping consumers. So if that's of interest to you, please consider subscribing to this channel, and please hit the like button if you enjoyed this video. I'd really appreciate it. It's easy to get caught up in the fear or hype or whatever you want to call it around the housing market because a change in the market has a direct impact on millions of people, and it's not just homeowners. The real estate market ultimately comes down to supply and demand. There's no doubt the market is heavily favoring sellers at the moment, and quite frankly, it's out of balance significantly. It's very frustrating for many buyers because the competition for houses is just so high. In fact, we really already have something of a housing crisis right now. It's an extreme shortage of inventory. Some examples I know of here in the Atlanta real estate market: 99 offers on a house, 47 offers on another house, 80 offers on another house we went and showed last weekend, 100 showings on another house just a couple of weeks ago, people offering $50,000 over the list price and still losing out to someone else. And you can go to a new listing and see lines of cars waiting just to get in and see the house. I mean, it looks and it feels out of control, and that, I think, is why people feel like we are in a bubble right now. So before we talk about whether the market will find balance, whether it's going to crash, or if it's going to keep rising, we really have to understand the market because it doesn't care how anybody feels. It's just a function of supply and demand. Here in Atlanta, at the time I'm filming this, we have about 5,500 homes available for sale, and that's been continuing to drop still all year long. There are 12,000 more under contract homes, which means we have nearly 2.5 times the number of pending sales as there are active listings, and at the current pace we're selling about 5,000 homes per month right now. Basically, we have a 1-month supply of homes, of single-family homes in one of the largest real estate markets anywhere in the United States. So we are definitely way too low on inventory right now, and that truly is a crisis. So if we're going to get to a place where prices are no longer rising, that is just to a place where they kind of level off, a couple of things will need to happen. You know, inventory is going to either have to rise, or sales are going to have to fall, or both of those are going to have to happen at the same time. So if it all came from just rising inventory, we would literally need 6 times the number of homes for sale that are currently on the market. And if it all came from lower demand, less sales, we would need about 84% fewer sales. And I really hope everybody can agree that neither of these things are even close to being plausible or anything like that could possibly happen. It would take a combination of increased inventory and reduced sales to swing the market. So we need to spend some time on each of these things to see if it really can happen. The biggest concern is forbearance, leading to an overwhelming number of foreclosures. The Mortgage Bankers Association's most recent report shows that loan delinquencies continue the trend of decline, and currently 5.22% of all loans are delinquent. The report goes on to say that 2.6 million homeowners are in forbearance, but new forbearance requests continue to decline, and they currently stand at 0.06% of total loan volume. This can seem like scary stuff, but I took a few minutes to read past the headlines, and when you get to the details, it really isn't quite as bad as it sounds. So here are some of the most important bullet points. And these are the results of what the Mortgage Bankers Association found on forbearance exits from June of 2020 through February of 2021, which is basically the entirety of the COVID effect so far. So these are up-to-date numbers. So what they found was 27.9% of borrowers who are in forbearance continue to make their monthly payments and are current. This is an interesting number. These people were allowed to not pay, but still had the means to pay, so they're still current, and that's a very good sign. 25.8% of other people resulted in a loan deferral or a partial claim. 15.4% resulted in reinstatements in which past due amounts are paid back when they exited forbearance. 13.8% represented borrowers who did not make all of their monthly payments and exited forbearance without a loss mitigation plan in place. And 7.8% resulted in a loan modification or a trial loan modification. 7.5% resulted in loans paid off through either a refinance or by already selling their home. And the remaining 1.8% resulted in repayment plans, short sales, or deed in lieu of foreclosures. So let me kind of distill that out for you. Of the 2.6 million homeowners currently in forbearance, a total of about 15.6% appear to not have any plan to get caught up as of yet. And since the foreclosure moratorium has now been extended through June of 2021, there isn't a rush for these people to even start worrying about it yet. Also, I think an important note is that 7.5% either refinanced their homes or sold it. So we already have a good number of these properties entering the market, and we are seeing absolutely no adverse side effects whatsoever given how low supply is right now. So it's important to remember that banks will also do everything they can to avoid foreclosures on the remaining people. Of course, there's going to be some, but most will end up being loan modifications and or some sort of a schedule to repay the missed payments. Again, banks just simply don't want to foreclose on homes. It is not their business model. It never has been, and it's never going to be. Remember also that since it takes months or sometimes even years, depending on how they're processed by different states, for foreclosures to even re-enter the housing market, so they definitely will not come on the market all at one time. It's going to look a lot more like a trickle than it is a flood. Also remember that the longer it takes for people to get to a place where foreclosure is looming because of the moratorium extensions, the better the economy will be running as lockdowns and shutdowns from COVID come to an end. More people will have jobs, less people will be forced out of their homes. All that said, nobody can accurately predict exactly how many homes will enter the market because of this. So some national perspective as to how low inventory is now and how many homes the market can absorb without crashing is definitely worth knowing. This chart gives you an idea of historical inventory levels, and you can see that we were running fine at around 1.5 million homes last March, pre-COVID, and it was a seller's market at that time. And this chart shows that at that time, to confirm that, it was about 3 months supply of homes nationally. With only 1 million homes in the market right now, we can see that it's reasonable to conclude that we could absorb probably about 1 million homes, and at the current rate of sales, we'd still be okay and probably reach what we would consider to be a balanced market. So based on the information from the Mortgage Bankers Association, it would be impossible to objectively conclude that anywhere near 1 million of those 2.6 million homeowners in forbearance will actually hit the market by either sale or through the foreclosure process. I would imagine it will end up being less than 500,000, and even if it's more, you have to also remember that it's going to happen over the course of, 1 to 2 years rather than all at once, making it much easier for the market to absorb all of those homes. So will forbearance be enough to crash the market or level off prices? No, not based on the information above from the Mortgage Bankers Association. It's simply not possible. Now we need to see if other dynamics will impact the number of home sales in such a negative way that when combined with more inventory, we would need to worry about a market crash. To do this, we need to look at the factors that can cause a slowdown in home sales. The main factors that historically contribute to slowing home sales are higher interest rates, higher unemployment, a change in some government regulations, and or more strict lending guidelines. So let's look at each one of these things. The Fed has signaled that they intend to keep the key short-term rate between 0 and 0.25% through at least 2023. So while it's possible rates rise slightly, mortgage rates aren't directly tied to the federal rate. They're related, and it's going to be a long time before we see them go high enough to harm the demand very much. There are also inflation fears, and they may push the rates up a little, but the overall economy and the Fed will continue to keep them low. Unemployment as a result of COVID was what most people thought was going to hurt the housing market in 2020. And here we are in 2021 with more sales than anyone could have imagined and the hottest market in recorded history. Since it's more likely that we're going to see unemployment go down and not rise further as the economy begins to reopen, this doesn't seem to be something we can count on to lower demand and therefore sales volume. Also, the Biden administration thus far has been very conscious of the housing market through the extension of the foreclosure moratorium, the proposal of a $15,000 first-time homebuyer tax credit, and the possible $10,000 student loan relief. I'm not going to be political in any way here, but don't expect many policies that will make it more difficult to buy a home over the next 4 years. This leaves us with one final major possibility to slow down the demand for homes, and that's through more strict lending guidelines. There's currently no talk of this. In fact, expect talk of making lending more friendly at the first signs it needs to. So this doesn't seem to be a plausible reason for a slowdown in sales either. So with all of that on the table, I would say it's possible that there's a slight slowdown in sales volume if interest rates tick back up slightly, but this doesn't seem like enough to worry about for the foreseeable future. The National Association of Realtors, Fannie Mae, and most other leading economists predict rises in prices for 2021 and sales to be nearly identical to 2020. Once you understand the workings of forbearance, it's hard to see a flood of homes from the cited source of the problem. It's easy to get caught up in what this feels like, but remember, markets don't feel. What actually happens is only a function of supply and demand due to the forces pushing them up or down. So in conclusion, I would say that we will ultimately see more inventory come on the market and perhaps a slight slowdown in sales. Neither of these on their own will be anywhere near enough to push us in the opposite direction to derail the market we're currently in, let alone make the market crash. Now, I could be wrong, but I'm of the opinion that the most likely scenario is a slight cool down in sales and a moderate uptick in inventory, which will lead us into a healthier, more balanced real estate market that, in my opinion, is desperately needed. The only possibility of a crash would be caused by irrational fear and not by any measurable metrics. Once again, my name is Ryan Ward. I hope you enjoyed this video, and thanks for watching.